Yusuf here. This is going to be part one of the 3 video series that I'm going to be making on market profile / volume profile. Before I can even start talking about market profile and volume profile, it's important to understand this idea of auction market theory. So part one is going to be me discussing auction market theory, and then part two will be me discussing the building blocks of market profile / volume profile, the different types of days, and the different types of opens. And then finally, the third part will be me discussing how I personally use volume profile and market profile, how I get levels, how I determine whether we're trending, in balance, etc. Real quick though, before I get into this video, make sure you're following me on Twitter if you're not already. I tweet lots of valuable information over there, such as daily plans, updates, intraday commentary, and stuff like that. Now that that's out of the way, we can go ahead and jump on into it. So, auction market theory. So what is auction market theory? Auction market theory is the best way of viewing the futures market and how its participants will react. Auction market theory focuses on 2 aspects, showing the two-way auction that is occurring and seeking fair value of an instrument. Understand that the market is not just candlesticks and indicators. There are people who are looking to conduct business at the best prices. Important to understand this idea of how buyers and sellers make a market. So, in terms of the elements of auction market theory, there are 3 main elements. They are price, time, and volume. Price informs us of the different opportunities that participants had. Time informs us on how long these opportunities lasted. And volume informs us whether an auction was successful or if it failed. So an example, we have a car that is released and they are currently being sold for $50,000. Buyers decide this is fair value and continue to keep buying at this price, so sellers decide to raise price due to the interest in buying. Let's say the sellers were to raise the price to $60,000, and when they do so, there are no interested buyers. Buyers deem that this is not fair value and that $60,000 price is not attractive to them. Sellers lower it back to $50,000, but even then, there's still no buyers that are interested. Sellers will have to keep on advertising price until it is deemed as attractive and fair value by buyers. So this idea of fair value and balance. Fair value is seen in the distribution of the market profile. The fair value is usually referred to as the value area. Value area is where we spent 70% of time for the market profile and conducted 70% of the volume for the volume profile. Value is always changing and shifting. It's important to determine where most participants find the most fair value. When we are in balance, the market is deeming these prices as fair value for the time being. Just a little side note, markets spend a majority of time in balance, about 80%. There's 2 types of buying and selling. The first is responsive. Responsive buying / selling is when an instrument breaks below or above its quote-unquote fair value. And buyers and sellers are excited to buy / sell because they see price as great value. Responsive buying is when an instrument goes below value. Buyers will come in because they think that the price is great value and will quickly rush to buy. Responsive selling is when an instrument goes above value. Sellers deem prices too high and rush in to sell and bring it back to its value. On the market profile, this is seen as something known as a tail. Once again, I'll be discussing this in part 2. The second type of buying and selling is known as initiative. So this is when buyers and sellers believe the price of an instrument is worth higher / lower value, so they will try to push it out of its current price. Initiative selling is when the instrument is below value. Sellers jump on the opportunity to take the instrument to a lower price they deem as fair / good value. Initiative buying is when the instrument is above value. Buyers jump on this opportunity to take the instrument to a higher price they deem as fair / good value. This can be seen as tails or single prints. Once again, we'll be discussing this in part 2. Next up, this idea of a successful and failed auction. Acceptance is when seen as when a buyer / seller takes the initiative to push price higher or lower, and we see acceptance of this new price and how it is deemed as fair value. Failed auction is seen when a buyer / seller takes the initiative, but not all market participants are in agreement, and they push price back to its quote-unquote fair value. We can base the acceptance and failed auctions based on the close and open of an instrument. Market participants. It's important to understand there are 2 types of market participants. So the first is the short time frame trader. These are usually retail traders who provide liquidity, and they tend to be day traders. Next up is the long time frame traders. These are banks, hedge funds, and other large institutions that hold positions for weeks, months, and even years. They're the ones that give us the large moves because they are the ones with the big money. Next up, one time frame markets and two time frame markets. One time frame is when there is one market participant in control of the entire day and we don't see any resistance from the other party. This tends to be reflected in trend days. Two time framing markets is when there are two long-term participants fighting. So a buyer and seller, price goes higher, but there's a seller who steps back in to push price back lower. Eventually a buyer steps back in to push price higher. These tend to be balanced days and no side has a real advantage. So as auction market theory, I'm going to quickly discuss what is market profile and show you a candlestick chart and then show you a market profile. So market profile is also known as a TPO chart. It stands for time, price, and opportunity. And it's a way to organize and display data using a bell curve. It shows us where participants believe price is fair value. It shows us the auction that is occurring for an instrument, and it allows us to identify trends and balance. So usually it tends to be represented in 30-minute periods, but when you switch to weekly, you can use a 240-minute. I'll be discussing this a little more in the video where I discuss how I use market profile. So this is a regular candlestick chart. Each candlestick represents 30 minutes. You have price over here, volume and time over here. So volume and time is being displayed on the horizontal axis, and then we have price being displayed on the vertical axis. And time, once again, volume is being based on time in the candlestick chart. Now this over here is the TPO chart. The TPO chart, it takes the volume, displays it in a vertical manner based on the price, and then it also takes the time, and it overlaps periods that that visited the same price. So I'm going to quickly go over here to this next slide, and this is a split TPO chart. Pretty much what this is each letter, these are pretty much letters, and each one represents a 30-minute interval. So some people can would view this as like a candlestick chart. So this would be 30 minutes, 30 minutes, 30 minutes, 30 minutes, 30 minutes, etc. And then this over here is when we just combine it, and then you can see how we get these distributions based on time, and then this is based on volume. Once again, this is just a basic little intro video to auction market theory. I'm going to dive deeper into market profile, what it is, the building blocks of it, and all that stuff in the next video. And I'll see you guys there. I hope this was helpful. Take care, everyone.